BlackRock, Fidelity, and Vanguard are silently shifting $50 billion into tokenized assets, signaling the end of traditional finance as we know it. While Wall Street executives move in silence, the specific infrastructure being built today leaves retail investors completely exposed to the coming liquidity trap. You aren't just watching a market trend. You are witnessing the systematic replacement of the current global banking backbone with a decentralized ledger that resets your portfolio's entire future. Let us get into the mechanics of this shift. We begin with the easiest, most visible win for institutional adoption. It started with the approval of spot Bitcoin exchange traded funds in early 2024. For years, major firms like BlackRock and Fidelity were sidelined because they could not legally custody assets that lacked a regulated wrapper. When the Securities and Exchange Commission finally gave the green light on January 10, 2024, the floodgates opened. BlackRock's iShares Bitcoin Trust, ticker symbol IBIT, became the fastest ETF in history to reach $10 billion in assets under management. Think about that. $10 billion in a matter of weeks. This was not retail speculators trading on their phones during their lunch breaks. This was pension funds, endowments, and registered investment advisors allocating a portion of their core portfolios to Bitcoin for the first time. The structure is simple, it is regulated, and it is fully integrated into the systems that major institutions have used for decades. If you are looking for the entry point of the institutional wave, this is it. It is the bridge between the old financial world and the new one. But here is where things get more interesting. Because once the infrastructure for trading exists, the focus shifts immediately to the underlying technology of ownership. This brings us to our second point, which is the institutional-grade tokenization of real-world assets. It is not just about holding Bitcoin anymore. It is about bringing traditional finance, or what they call TradFi, onto the blockchain. Larry Fink, the CEO of BlackRock, famously stated that the next generation for markets is the tokenization of every financial asset. We are seeing major banks like JP Morgan testing private, permissioned blockchains for cross-border settlements. In a pilot study using their JPM coin system, the bank moved hundreds of millions of dollars in seconds, compared to the multiple days required by the legacy SWIFT network. Imagine a world where stocks, bonds, and real estate are all represented by digital tokens. You could trade a skyscraper in Manhattan as easily as you trade a share of Apple stock. The efficiency gains are massive. You eliminate middlemen, reduce settlement times to near zero, and gain total transparency through distributed ledgers. This is the stage where the technology stops being a speculative asset and starts becoming the foundation of the global financial backbone. It is not just an upgrade. It is a total overhaul of the plumbing. This is the layer that separates the casual crypto investor from the serious player who understands where the real capital is flowing. If you are finding this breakdown useful, hit subscribe. I drop deep dives like this every single week to keep you ahead of the curve. I promise the best is coming up next, because the final piece of this institutional puzzle is the one that most analysts are completely missing. Now, prepare yourself. Remember how I mentioned the best was coming? Here it is. The real game changer is the integration of programmable, smart contract-based compliance. Most people think of crypto as the Wild West, a place where regulations go to die. But the institutions see the exact opposite. They see a future where the law is written directly into the code. Let me explain. In a traditional system, compliance is a manual, messy process. You have to hire armies of auditors and lawyers to check signatures and cross-reference databases to ensure that anti-money laundering rules are followed. But with programmable compliance, the rules are executed by code. If you try to send an asset to a sanctioned wallet, the smart contract simply rejects the transaction before it ever happens. It is automatic. It is instantaneous. And for an institutional investor managing trillions of dollars, that level of risk mitigation is worth more than any price appreciation in Bitcoin. This is what we call institutional-grade DeFi, or decentralized finance. A 2024 report by the Bank for International Settlements highlighted that the true utility of blockchain is the ability to automate trust. When firms like State Street or Goldman Sachs start deploying their own nodes on public blockchains, they aren't just playing around with digital currency. They are building a system where identity, compliance, and asset movement are locked together in a secure, transparent environment. This makes the financial system not just faster, but mathematically safer. Think about the implications. Once you see that the biggest players on Earth are prioritizing programmable compliance over raw volatility, you realize that crypto has moved past the era of the retail rebel. It is now the era of the institutional architect. Let that sink in for a second. We have moved from retail speculation to the massive influx of ETF capital, to to the deep structural shift of tokenization, and finally to the programmatic enforcement of global financial law. Each of these steps is a layer of legitimacy that makes a return to the old way of doing things impossible. You cannot go back to clearinghouse delays and manual ledger entries once you have tasted the efficiency of a global 24/7 programmable network. The institutions know this. They are not investing for the price of Bitcoin next Tuesday. They are positioning themselves for the next 50 years of global commerce. They are buying the infrastructure. They are buying the standards. And they are buying the trust that only code can provide. If you got value from this, share it with someone who needs to see the bigger picture and subscribe so you don't miss our next breakdown. We are going to be tracking how these institutional moves impact specific sectors in our next video. There is a shift happening, and if you are paying attention, you are already miles ahead of everyone else. Keep watching the flow of the capital, not just the headlines in the news. It tells the only story that matters. We will see you in the next one.